Well, there's been a lot of talk lately about this shocking silver price swing, about whether gold and precious metals are finally about to break into a whole different gear, and about whether what we're seeing right now is the start of something much bigger. So in this video, we're going to separate signal from noise, and you are going to walk away feeling a lot clearer, a lot calmer, and a lot more confident about what may actually be happening here. By the way, in New York, it's Friday, April 10th. And tell me in the comments what day and date you're watching this from. And very quickly, if you value my content and want to support what I do, subscribe and comment John A.G. Best down below. That really helps. Now, before we get into the charts, the cycles, the fear, the excitement, the huge upside calls, and all the talk about silver being held down and then suddenly unleashed, let's begin with the thing that matters most. Not the loudest claim, not the wildest target, not the most dramatic headline. The thing that matters most is this. What are we actually looking at? Because a lot of people see a violent swing in silver and immediately jump to one of two extremes. Either they say, this proves the breakout is finally here and silver is going to the moon right now. Or they say, here we go again, another fake move, another head fake, another disappointment, nothing ever changes. And honestly, both reactions are usually too fast. Because when you slow this down and when you really look at the structure of what's going on, you can see why emotions are running hot. You can also see why so many people keep getting caught at exactly the wrong moment. And maybe more importantly, you can see why this market can still be bullish without every single bullish claim being correct. That's the key tonight. A lot of viewers have been hearing the same story, repeated in different forms. Silver tried to run, then it got hit. Gold looked strong. Then it backed off. A big move was expected earlier. It didn't fully show up. Now the next window is supposed to matter even more. Mid-April matters. Late April matters, May matters, a breakout matters, a reversal matters, a spiritual turning point matters, a monetary turning point matters, everything matters. And when everything matters, people get overwhelmed. So let's simplify it. The first thing I want to say is this. It is completely fair to notice that silver has been acting differently. The swings have been bigger, the emotion has been bigger, the conversation has been louder, and the conviction on both sides has been getting stronger. That part is real. But it does not automatically follow that every sharp intraday reversal is proof of some all-powerful hand flipping a switch. Sometimes markets are crowded, sometimes liquidity gets thin, sometimes traders chase momentum and then dump it back into the close. Sometimes macro headlines hit at the worst possible moment. Sometimes options dealers, fund flows, rate expectations, energy prices, and geopolitical nerves all hit the same tape at the same time. And when that happens in silver, the move can look almost theatrical. That does not mean nothing strange ever happens in metals. It means you have to be careful before turning a messy market into a single clean story. That's where people can get trapped. Now, one reason silver keeps pulling people in is because it sits in this weird place between money, industry, fear, and hope. Gold can trade like a clean reserve asset. Silver rarely behaves that politely. Silver can feel like money one week, an industrial metal the next week, and a leveraged emotion machine in between. That's part of why it moves the way it moves. And from recent market updates, the macro backdrop is still giving metals investors a reason to stay alert. The Fed kept rates unchanged in March, said uncertainty around the outlook remains elevated, and specifically pointed to risks tied to the Middle East, tariffs, and sticky inflation. Recently published inflation data also showed the Fed's preferred measure still running above target while consumer spending rose in February. That is exactly the kind of environment where metals keep getting a second look, even when the path is messy. So when people say, why are gold and silver suddenly back in the center of the conversation? That's part of the answer. They are responding to a system that still doesn't feel settled. They are responding to a market that keeps repricing inflation, growth, rate cuts, oil, war risk, and policy risk all at once. And they are responding to a deeper anxiety that a lot of people have but don't always say out loud, which is this. What if the system is functioning, but less sturdy than it looks? What if confidence is still there, but thinner than people think? What if the next move in metals is not about apocalypse, but about trust slowly leaking? That possibility matters more than the crazy targets. Now, the next big point is the one that keeps showing up in almost every silver discussion: suppression. You hear it in different words, but the idea is basically the same. If silver were allowed to trade freely, it would already be much higher. If it got too high, it would make people question paper money. It would pull attention away from the banking system. It would expose how unstable things are. Therefore, according to this view, it must be pushed down whenever it starts getting too much momentum. And look, I understand why people find that argument attractive. Because if you've watched silver for years, you've seen it do things that make no emotional sense in the moment. Strong move overnight, weak close by afternoon, Breakout look in the morning, deflation scare by evening, excitement in one session, exhaustion in the next. It can absolutely feel like somebody keeps putting a ceiling on the room. But here's where I want to push back a little bit. Not to dismiss the concern, just to sharpen it. The fact that silver gets sold hard does not prove that price is being defended at every moment for one single reason. And the fact that silver has not yet exploded into some insane number does not mean the only explanation is deliberate suppression. There is another explanation, and it's a more boring one, which is exactly why people don't like it. Silver is a volatile, relatively small market with a split personality. It attracts true believers, short-term traders, industrial hedgers, macro funds, and people who want a monetary hedge but have less capital than they'd need to build the same position in gold. That creates a market where conviction can be deep, but the behavior can still be unstable. And according to the latest public positioning data, open interest in silver futures pulled back week over week at the end of March, while commercials, speculators, and spread traders all remained active pieces of the same machine. CME's own volatility tools also point to a market where expected swings are still elevated. In plain English, this thing is built to overshoot both ways. That matters. Because if you don't understand that, you'll misread every reversal as proof that your favorite theory is correct, and that gets expensive. Now, does that mean the broader idea behind owning precious metals is wrong? Not even close. In fact, I think a lot of people are directionally right for the wrong reasons. That happens all the time in markets. A person can be right that metals have room to run, but wrong about the exact trigger. A person can be right that trust in paper assets is wobbling, but wrong about how fast that trust can actually unwind. A person can be right that silver is undervalued in a broad historical sense, but wrong to assume that means straight line upside starts tomorrow morning. That distinction is huge, because one of the more dramatic claims floating around right now is that we are on the edge of some immediate event that changes everything all at once. Maybe it's political, maybe it's financial, maybe it's military, maybe it's spiritual, maybe it's all of the above. And once that spark hits, according to that version of the story, the dollar loses the throne, silver explodes, gold launches, and the old order just starts cracking in public. Now, could there be a major turning point ahead? Of course. Should you be watching for one? Absolutely. But let's keep our feet on the ground for a second. The latest official reserve data still show a world that is holding enormous foreign exchange reserves, and the dollar's role in that system remains very large. So the idea that the dollar is about to vanish overnight, or be cleanly replaced in one fast dramatic sequence, is not supported by the latest public numbers. If change comes, it is far more likely to look uneven, political, and slow at first, than obvious only in hindsight. That, by the way, does not weaken the long-term case for metals. It strengthens it. Because the strongest case for owning gold and silver was never that the entire monetary order would disappear by next Tuesday. The stronger case is that the world can stay messy. The currency can stay dominant. Inflation can stay annoying. Policy can stay reactive. Debt can keep growing. Confidence can keep eroding at the margins. And in that exact kind of world, people still keep reaching for hard assets. That's the point. You do not need a Hollywood ending for metals to work. And I think that's one of the biggest mistakes people make in this space. They start rooting for the most dramatic version of reality, because it feels like the fastest path to higher prices. But if markets truly stop functioning cleanly, if pricing truly breaks, if policy truly panics, if restrictions suddenly expand, that is not some clean victory lap for holders of metal. That is chaos, and chaos is a terrible thing to build your plan around. What you actually want is repricing with enough order left in the system that gains can still be realized rationally. That's a lot less exciting. It's also a lot smarter. Now let's talk about this idea that silver threatens the system more than people realize. There is something real inside that argument too. Not because one coin instantly topples banks, not because one rally ends paper money, but because physical metals represent a kind of financial independence that modern systems don't fully love. If you hold metal outright, outside leverage, outside promises, outside a layered chain of counterparties, you have stepped a little bit outside the architecture. Not completely, but a little. And that little bit matters to people, especially after the last several years, when more investors started asking questions about access, control, surveillance, settlement sanctions, counterparty risk, and what happens when convenience becomes dependence. That is why this story keeps attracting both analysts and almost missionary believers. Because underneath all the chart talk, people are really arguing about freedom, trust, and who gets to stand in the middle of every transaction. And yes, that is bigger than price. And that helps explain something else people notice every time silver wakes up. When silver starts running, even a little, it spreads socially in a different way than most assets. Your neighbor hears about it. Somebody at the gym mentions it. A relative who never talks about commodities suddenly asks if this is the moment to buy a few coins. Silver does that because it still feels reachable. Gold can feel distant. Silver feels like something ordinary people can still touch. And when something feels reachable, attention can go from quiet to frantic in a hurry. That social rush is part of the pattern too. It's one reason silver rallies can become self-feeding for a while. People buy because the story becomes contagious. They buy because they missed the last move. They buy because tangible wealth feels emotionally different from a number on a screen. And then, right when the crowd starts to feel clever, the market does what it so often does. It snaps back. That is not a new movie. Which means one of the smartest things you can do in a silver market is learn to separate attention from durability. A move can be real and still get overextended. A rally can be healthy and still attract late emotional buyers who make the tape look stronger than it really is for a day or two. A pullback can be ugly and still not destroy the larger setup. If you don't understand that, you will confuse social excitement with structural confirmation. Now let's talk about the banking side of this for a minute, because this is another place where viewers feel something real, even when the rhetoric gets overheated. A lot of people who buy precious metals are not doing it because they think they are about to pay for groceries with a coin tomorrow afternoon. They are doing it because metal represents settlement that does not depend on someone else's permission. In a world where almost every transaction routes through a bank, a processor, a platform, an app, or some other middle layer, the appeal of holding a bearer asset is obvious. You don't need to be anti-bank to understand that. You just need to understand concentration of control. Because once enough of your life runs through systems you do not control, convenience starts carrying a hidden price. That hidden price is dependence. And a lot of metals buyers are responding to that feeling. They want at least some part of their savings in a form that is simple, direct, and outside the stack of promises. That is a very different argument from saying silver replaces everything. It doesn't have to replace everything to matter. It just has to serve a role that other assets do not serve the same way. And that is why the debanking conversation has landed so hard with this audience. People have seen enough to know that access can become political, procedural, or conditional faster than they once assumed. Once that realization hits, the case for holding at least some tangible asset becomes emotionally intuitive, even for people who are not hardcore metals people. Now, where I think some silver bulls go too far is when they act as if privacy alone guarantees runaway price. It doesn't. A thing can be useful, private, tangible, and still deeply volatile. A thing can be outside the everyday banking rail and still spend long stretches going nowhere. So yes, there is a freedom angle here. Yes, there is a settlement angle here. Yes, there is a middleman angle here, but those are long-range forces. They do not force a clean breakout on your preferred date. The other piece that deserves attention is storage. When metals investors get more serious, they stop talking only about price targets and start asking boring but important questions. How much physical exposure do I actually want? Where do I keep it? How liquid is it? What are the trade-offs between home storage, private storage, and paper exposure? What risks am I reducing, and what risks am I adding? Those are grown-up questions. And they matter because conviction becomes real the moment logistics become real. If you're a newer viewer and you're tempted to jump straight from excitement to extreme action, slow yourself down. It is better to build a plan than to build a fantasy. Some people are buying metals as insurance. Some are buying them as speculation. Some are buying them as a distrust trade. Some are buying them as a diversification tool. Those are not the same thing, and if you mix them together in your head, you'll make confused decisions. And let me give you one last practical filter. When a market starts attracting huge claims, ask whether the claim helps you manage risk or just feeds emotion. If it only feeds emotion, it probably belongs in the background. If it helps you size positions, pace entries, think about exits, and stay sane during reversals, it has real value. That is how you keep a metals thesis useful instead of theatrical. The people who do best in this space are usually not the loudest believers or the loudest skeptics. They are the ones who can hold a strong view without letting that view turn into a blindfold. And in a market like silver, that skill is worth more than one perfect prediction. That is especially true when the market is swinging hard, because volatility punishes ego faster than it punishes ignorance. Ego keeps you stubborn. Curiosity keeps you adaptive. In precious metals, adaptive usually survives much longer. Now, some people take that bigger idea and push it into a spiritual frame. They say this is not only a financial battle, they say it is also a moral one. They say something much larger than ordinary policy may be about to force a reordering. I'm not going to mock that. I'm also not going to trade on certainty about it, because once you move from market analysis into prophecy, you're no longer just asking what price might do. You're asking what history is about to mean. That requires humility. It really does. You can believe there is a spiritual layer to what's happening without pretending that every date window, every candle, every rally, and every reversal carries a guaranteed, divine timetable. That's where I think some people get ahead of themselves, and it creates a different kind of risk, not just financial risk, psychological risk, because when somebody ties a forecast to destiny, and then that forecast misses, the audience doesn't just feel disappointed, they feel disoriented. The emotional damage is bigger than a normal bad call, because the claim was bigger than a normal bad call. So I'm asking you to do something very simple here. Hold conviction without demanding instant confirmation. That's hard, but it's necessary. Now let's turn to the actual rhythm of the market, because this is where the story gets interesting again. A lot of the excitement right now is being built around timing windows. The argument goes like this. A sharper rise was expected earlier, it did not fully arrive, but the larger structure still points higher. The next several sessions matter, then the next cluster matters even more. Then the latter part of the month could become the real launch area. Then sometime after that, we may get a hard pullback even if the larger move is still intact. If you've been around metals for a while, you've heard versions of that before. And here's my honest view. That framework is not crazy, but it is incomplete. Why? Because cycles can be useful for direction, useful for rhythm, useful for alertness, useful for recognizing when the market is entering a zone where reactions may get bigger. But cycles are not permission slips to stop thinking. If a cycle says the next few days lean constructive, that can be helpful. If a cycle says late April carries more fuel than early April, that can be helpful too. But the moment someone starts acting like the calendar itself is going to force price to obey, that's where trouble starts. Markets still need catalysts. They still need flows. They still need narrative energy. They still need positioning to be vulnerable in the right direction. That's why I tend to respect windows and distrust certainty. And there's another reason to be careful. From recent Federal Reserve commentary, policymakers are openly dealing with a mix of tariff uncertainty, higher energy prices, and Middle East risk, while still trying to push inflation back toward target. That means markets are hypersensitive right now. A single headline on inflation, oil, rates, or geopolitics can overpower the cleanest-looking setup for a while. So yes, the market may be leaning toward a stronger phase. But no, that does not mean the path will look tidy. That is why silver can look ready one minute and wounded the next. Now, there is one part of the bullish case I think deserves more attention, and it does not get discussed enough because it is less cinematic. Supply matters, but not in the simplistic way people usually frame it. Silver is not just a story about pure silver mines flipping a switch and flooding the market. According to the latest mineral summaries, a meaningful share of future silver supply is still expected to come as a byproduct from other mining activity, especially deposits tied to gold, copper, lead, and zinc. In other words, silver supply does not always respond neatly to silver's own price story. At the same time, the U.S. Geological Survey recently said the value of domestic mineral production rose last year, with help from precious metals prices. That tells you interest is real, but it also tells you this market is connected to a much broader production chain than social media sometimes suggests. That's important, because it means silver can tighten and remain structurally interesting without every supply argument turning into a countdown clock. Again, nuance. Not as fun as a panic headline. Much more useful. Now let's come back to the emotional core of this whole thing, because I think that's what most viewers are really trying to navigate. What people want to know is not just where can silver go. What they really want to know is, am I early or am I wrong? That's the real question. And the frustrating answer is that in metals, those two feelings can look exactly the same for long stretches of time. You can be right on the bigger move and still sit through ugly reversals. You can identify a strong long-term thesis and still watch the short-term tape disrespect you over and over. You can see inflation stay sticky, debt stay huge, policy stay reactive, and confidence stay shaky, and still not get the smooth, clean breakout you imagined. That is one reason precious metals investing is mentally harder than people realize. It's not just about having a thesis, it's about surviving the path. And that is why discipline matters more than excitement. If your whole plan depends on silver doing something vertical by a very specific date, you're not really investing anymore. You're emotionally renting a prophecy. That is not where you want to be. A stronger approach is to say, look, the bigger environment still gives hard assets a seat at the table. Inflation is not fully gone. Policy confidence is not fully restored. Geopolitical risk is not fully resolved. The rate path is not fully trusted. The dollar system still dominates, yes, but dominance is not the same thing as untouchability. Gold is behaving like something the market still respects. Silver is behaving like something the market still cannot fully decide how to price. That's enough. You don't need a $1,000 coin tomorrow morning for the thesis to stay alive. Now, I also want to speak directly to the people who got excited on the last big move and then got punished on the reversal. You are not stupid, you are not cursed, and you are definitely not the only one. This market has a habit of making people feel brilliant near local highs and embarrassed near local lows. That's one of its favorite tricks. Which is why you need a framework that survives both. If you're successful, share your success story in the comments so others can stay motivated. Seriously. Because a lot of people only talk when they're euphoric or angry. They don't talk about patience. They don't talk about sizing. They don't talk about how they learned to stop chasing every spike. Those are the stories that actually help people. And if you're still learning, that's okay too. The real goal is not to win every swing. The real goal is to avoid letting the swing own you. Now, before I wrap this up, let me give you the balanced version of what I think may happen next. I think the market still has room to surprise to the upside. I think gold remains the steadier signal. I think silver remains the louder one. I think a stronger stretch into the next cluster of trading days is plausible. I think later April could matter more than people think if the macro tape stays tense and metals keep attracting defensive interest. I also think a sharp shakeout after a strong move would surprise absolutely no one, because that is how silver behaves when too many people start speaking with certainty. So yes, I see why bullish people are excited. But I also think the most responsible position right now is confident caution, not fear, not blind faith. Confident caution, watch the action. Watch whether gold confirms, watch whether silver can hold gains instead of only flashing them. Watch whether macro headlines keep feeding safe haven demand or start crushing it. Watch whether the market begins to treat metals as insurance, as momentum, or as collateral damage from a broader risk move. Those distinctions matter. And one more thing. If you're building your whole outlook around the idea that one rally will end the dollar, replace the banking system, and settle every argument at once, I think you're probably reaching too far. But if your view is that the world is still carrying too much policy uncertainty, too much debt dependence, too much geopolitical stress, and too much fragile confidence for hard assets to be ignored, then I think you're standing on much firmer ground. That is the difference between drama and thesis. So here's the bottom line. Silver does not need mythology to be interesting. It does not need every reversal to be a conspiracy. It does not need every date window to become destiny. And it definitely does not need the entire system to collapse for holders to do well. What it needs is exactly what we may already be getting. Persistent uncertainty, sticky inflation psychology, a market that cannot fully relax, a monetary backdrop that still feels unstable around the edges, and enough real demand for tangible assets that every pullback keeps finding believers. That is a powerful mix. Maybe not as fast as some people want. Maybe not as dramatic as some people promise, but powerful. And that's why I think the silver price swing actually matters. Not because it proves every extreme prediction, but because it reminds you that the market is still alive to this story, still sensitive to it, still not done with it. And if the next move really is stronger than the last one, the people who stay level-headed are going to be in much better shape than the people who keep lurching from miracle to panic and back again. So tell me this in the comments too. Do you think silver is building toward a real breakout, or is this another setup designed to test people's patience before the bigger move finally arrives? Subscribe if you want clear analysis without the noise. And just remember, this video is for education and discussion only. I'm sharing how I see the market, not telling you what to buy, what to sell, or how to risk your money. Your decisions are your responsibility, so slow down, do your own homework, and make moves you can actually live with.